Hello friends, welcome to my channel Impart Knowledge. If you are new to this channel, consider to like, share and subscribe. Also press the bell icon to receive notification whenever a new video is uploaded. Let's get started. In this video, today we will discuss about terminologies of life insurance, and this is series part 1. So let's get started. The first terminology is policyholder. The person who owns the policy, also known as the policy owner. So let's say if one is buying the policy and also paying the premium by herself, himself, becomes the policy holder. Next is life assured. The person for whom the insurance is bought. This may or may not be the same as policy holder. So for example, let's say if you buy insurance for spouse and pay premium as well, so in that case you will be the policy holder, wherein life assured would be your spouse. The next one is nominee. The nominee or beneficiary is the one who inherits the sum assured in case of demise of the life assured during the term of the policy. So now, while applying for the policy, the person has an option of adding nominee in the policy. Now, if I want, during my policy term, I can always add and change my nominee. In fact, I also have an option of keeping multiple nominees in the policy, which has to be among the blood relation, and I can divide a set of percentage. So for example, maybe 50% for mother, 50% for spouse, or let's say 50% for spouse, 20% for son, and remaining 30% for daughter. So in a proportionate, the way person wants, can set a specified percentage and add and change, keep multiple nominees. The next one is sum assured. The amount that the company pays to the nominee in case of the death of the life assured in the policy. For example, let's say Mr. X buy policies for 1 crore. Now, in case of death of Mr. X, this 1 crore would be paid to nominee. So this 1 crore value, this is called sum assured in your insurance terminology. So whatever amount that would be paid to the nominee is called sum assured. The next one is policy term. A period for which insurance policy is active or valid. This can differ from policy to policy. So let's say for example, let's say if I am going for, let's say, a term insurance plan, and let's say I want to take the policy, let's say only for next 30 years, I can do that. Or let's say if I am going for an investment policy and I want the returns, let's say in 10 years or 15 years, so I can do that. So whatever tenure that you select in the policy becomes your policy term in the policy. Moving on to the next one, which is premium. So this is a fixed amount that the customer pays to the insurance company in return of insurance. This could vary from policy to policy depending on various factors. Now when it comes to premium, so one company of course gives me different payment options. So I have an option of monthly, half yearly, quarterly, yearly, basis which I can select one and pay my premium. Now premium will also vary from person to person basis the option that one selects in the policy. So that would depend on, let's say, age, gender, what sum assured you select, what is, person is smoker, non-smoker, and if it is, let's say, for an investment plan, what amount, let's say, you want to invest. So depending upon various factors, the premium is calculated, and for each person this will vary. The next one is payment mode. It refers to different ways of paying premium to insurance company. So there are 3 types of payment mode. So we'll discuss each one by one. So this is regular pay, limited pay, and single pay. So what do we mean by this? So now, let's say for an example, I am taking a term insurance and this is, let's say, for next 30 years. Now, I have an option to pay my premium on a regular basis, which means for next 30 years if I want, I can keep paying my premium for next 30 years regularly each year. This is called regular pay. Now, what is limited pay? So, if my policy is for next 30 years, I don't want to pay a regular premium and keep that burden. Rather, I will go for an option where, let's say, I can pay my premium just for 5 years or 10, 15, 12 years, whatever option is available, but still be covered for next 30 years. So, the entire coverage would be for 30 years. The entire benefit would be for 30 years, but I am paying my premium before 30 years. So it is for 5 years, 15 years, 20 years, depending upon various options that would be available in the policy. This is called limited pay. Now, what is single pay? So single pay is an option wherein I am saying I am not interested to pay my premium on a regular basis. Neither I want to pay, for 5 years, 10 years in a limited pay, but I am interested to pay a lump sum amount in the policy. So in the beginning of the policy, I will pay a complete amount at one go. So this is how your single premium benefit works. The next one is death benefit. A sum of money that insurance company pays to the nominee in case of demise of the life assured in the policy during the policy term. So, if my policy is for 30 years, if anything happens, I have taken a sum assured of 1 crore. This 1 crore, which is called the sum assured, company will give to my nominee. So, this 1 crore amount that would be paid is the death benefit that would be paid to the nominee. The next one is maturity benefit. The amount that the policyholder gets if he or she survives the policy term. So, let's say if I have taken a policy for 20 years, I have taken an investment policy and nothing happens to me during these 20 years. If anything happens, then the sum assured would be paid to my nominee. But if nothing happens to me during these 20 years, I will get the maturity benefit. So whatever amount that I will get on maturity is called the maturity benefit. The next one is riders. These are add-on benefits to your policy. Now, when it comes to riders, so riders are nothing but it is an additional benefit, additional options that you can add in the policy. So it is not mandatory that you have to add these additional benefit in the policy, but of course there are various benefits of adding these riders in the policy. Now, depending upon company to company, policies to policies, there are different kind of these additional riders which are available in the policy. So rider comes at a very nominal premium. So if one wishes to add riders in the policy, can do that. The next one is claim. A claim is required to be filed with insurance company to to receive the sum assured in case of demise of the life assured in the policy. So, in case of any unforeseen event, the nominee will have to register a claim with insurance company. So, the nominee will have to come and intimate the insurance company that the demise has happened, basis which the insurance company will initiate the claim process further. So, this is called claim. The next one, the last one for today's video, this is freelook. Now, what do we mean by freelook? So, it is an option to cancel the policy within the stipulated time. So, let's say if today my policy is issued. Now, as per the regulator, every company has a clause in the policy document which states that if I want to go ahead and cancel my policy within a stipulated time, so this would differ from policies to policies. This could be for 30 days, 15 days. I have an option to go ahead and cancel my policy. This is called free look period in the terminologies of life insurance.